You know, last week China's stock market sneezed and all the world markets reacted. For more on this pension reform and what it means for China's markets and the economy, I'm joined now by Dan McClory. He's a managing director and head of West Coast investment banking for Burnham Securities. Dan, welcome to the broadcast. Thanks for joining us.
Thank you, Susan. It's great to be here on a Monday morning in Beijing.
Absolutely. Tell us, what kind of reaction do you think this news that pension funds will be able to invest 30% in the stock market have?
Well, you know, last week was a really tough one for China. We're in the midst of a triple transition here. So liberalization of the financial markets, a rebalancing of the economy, and finally sustaining what some would say is probably an unrealistic rate of growth. I think world markets are saying, what's going to give? Nowhere in the history of the developed world has a nation been able to execute simultaneously on three such major initiatives. So it's not surprising that Friday started out with extreme volatility, starting in Asia, spreading west to Europe, and eventually ending up in the US. I think markets are going to be tentative and cautious today. We may see a further sell-off.
Wow, that's big news. So it started with the de-escalation, obviously, and then it moved on to manufacturing numbers. What else precipitated this?
I think there's some lack of credibility in the indices in China as a result of moves in July, where up to a third of the companies who were listed in Shanghai were able to self-suspend their shares. So then you look at the index and its performance, where you have only the good constituents left. Is that really indicative of what's going on in the market? So I think markets are saying, can we rely on these numbers? And remember, the stock exchange in China came about as a way to make capital more efficiently flow to both the private sector and state-owned enterprises. With IPOs being suspended for the time being, and with further share issuances on the exchange in form of secondary offerings not taking place, that's being called into question. So what we're seeing now is investors at a global basis that want to play the Chinese equities game going to places like Hong Kong, but even increasingly NASDAQ, the New York Stock Exchange, and US-listed Chinese companies, which we're happening to see as a result of underwriting activity for IPOs.
Dan, we've seen over the past few weeks the young investors in China on their mobile phones following everything so closely. The older investors maybe taking money out. What do we expect to see? Do we expect that trend to continue?
Well, I think we heard just a few minutes ago about the various levels of intervention that are taking place. And again, these levels are also unprecedented. So I think there's strong support for intervention from the government to allow the stock market to not have any form of a crash landing. Remember, even though Shanghai is down a third since June, it's still up 56% from last year. But when I talk about unprecedented levels of capital, there are some estimates that say upwards of $300 billion have flowed into propping up the Chinese stock market. And that greatly pales in comparison on a relative to GDP basis, the amount of money that, for example, the US put into its troubled asset relief program of about $700 billion immediately following the global financial crisis in 2008. So I think this shows the commitment of China to want to achieve stability and to want to continue to use the stock market as an engine of growth. We're just going through a period of great turbulence.
All righty, those hopefully will hang on for the long haul. Dan Burnham Dan McClory from Burnham Securities, thank you for that.